Good evening, everyone, and thank you for joining us again. Welcome to Ironwood Wealth Management's Market Insight webinar for Q1 2019. My name is Nick Basso, and I'm a portfolio administrator in Ironwood's Asset Management Division. Tonight, it's my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If any one of the attendees has questions for Sean during the presentation, please type those into the chat box that is attached to your webinar panel on your screen. I'll compile the questions and we'll do our best to address all of them at the end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, please take it away.
Thanks, Nick. Thanks, everyone, for joining our call this afternoon. It's a much better feeling today versus our special webinar about a month ago, at the beginning of January. Markets and portfolios are up significantly since then. But unfortunately, this doesn't necessarily make our job easier. It actually, unfortunately, makes our job a little bit more difficult now versus 1 month ago. And over the next 45 minutes or so, we'll kind of discuss why we think it's a little bit more challenging environment now than say a month ago, and a lot of it has to do with attractiveness and prices. So without any more delay, we'll go ahead and jump into the presentation. So what a difference a month makes. Like I said earlier, we had a fantastic, anything that could have gone wrong in October, November, and really December did go wrong, and markets definitely took it on the chin the fourth quarter of last year. But basically everything that went wrong in those 3 months went exactly right in January. As you can see here, S&P 500 and well, this is year to date, and this was a couple days ago, but you still get the point here. S&P up 9%, emerging markets up about 9%, developed international 6.5%, small cap domestic, which Ironwood has a little bit of an overweight to, up almost 13%, and even global bonds. Were up during year to date so far, about a percentage point. So definitely has had a positive impact on portfolios, on people's confidence, on people's moods, versus where we were Christmas Eve. It's not all rosy. There definitely is a global slowdown coming, and the stock market is usually one of the leading economic indicators. And some of the other economic indicators that we look at basically confirm that the stock market had it right in October, November, December, with the extent of at least the global slowdown. And then in January, really by Christmas Eve, the market had gone a little bit too far and was pricing in recession. And it doesn't appear that recession is going to happen globally. And that's when we see the snapback in prices. But with that said, there definitely has been a global slowdown. We can see that if we just look at global PMI numbers, in December we had 51.4, which any reading over 50 means we're expanding. So we're still expanding, but we had higher numbers at the end of 2017, at the early part of 2018. But January, we declined even further. I would imagine to see these numbers actually start to increase, because we've had a little bit of less trade rhetoric going on, which has had a big impact on this via really China, Korea, and Taiwan. You can see all of them. They're actually contracting. There are a few others that are contracting, but emerging markets in general has contracted a little bit, and that really kind of solidifies why the market last year in the first half of the year was really penalizing emerging markets and developed international countries. A lot of it was China related. Europe has a lot of exports that go to China that a slowdown in China impacts Europe. So there's a lot of moving parts there. But you can see the United States is actually at 54.9 in January and has turned back around. But it's not the only time in this recovery that we've seen slowdowns. I mean, even in 2016, we had some yellows. 2015 and 2016, we had some yellows. So if you remember 2016, those yellows were before a period of time when the S&P 500 and global stocks went up tremendously from 2016 to 2017. So it doesn't always give you a great idea on where the stock market's going to go, because it really depends on prices and valuations. But it does confirm the slowness and some of the weakness we saw late last year in the markets, which has caused the Fed to back away from more rate hikes. There's actually about the same probability that they increase rates for 2019 as there is that they decrease interest rates. I believe actually that there's a higher probability slightly for cuts than for increase. So that's just a complete turnaround from where they were October 3rd when Jay Powell said they were pretty far from normal. So the markets have liked the fact that the Fed is basically on hold. The 10-year Treasury bond yield dropped over 50 basis points to 2.65% as of today. It's a much easier environment for stocks when rates are lower, and you know, they had gotten up to about 3.25%, 3.25%. So we've really seen a large drop in the 10-year Treasury, and with that, the yield curve has steepened a little bit. We got to about 10 basis points from the 10 versus 2-year Treasuries, and when if that had inverted, a lot of economists would have predicted that we would have had a recession within the next year if that would have happened. We avoided that. If we got down to about 10 basis points, it's currently at about 20 basis points. The recent Fed on hold dovish stance has started to steepen that a little bit, which I'm sure the Fed likes to see that. Stock markets, like I said before, had really priced in a recession, and with some of the data that came out in early January, late December, early January, we were getting a lot of good reports, which caused the recession fears to subside. We have had some decent trade rhetoric with China, the United States and China, the trade deal, and so the combination of that with lower rates and an accommodative Fed has given us a really spectacular start to 2019. With that said, the U.S. economy still looks to be very strong. ISM manufacturing and non-manufacturing still look good. The jobs market looks fantastic. Every time we have a jobs number, it seems like we're beating the expectations, with the exception of the unemployment rate, which I don't believe is a cause for concern. The unemployment rate actually went from 3.7% to 4% over the last 2 months. But what also happened over that period of time is that we've had a significant increase in the participation rate of the labor market, which means a bunch of despondent workers who thought they could never get a job. The economy's gotten so much better that now they believe they can get a job, and when they've been answering questions when they've been called and say, hey, are you looking for a job? Previously, they'd say, no, I'm not looking for a job. A lot of those people now are looking for jobs. People are coming off of disability and very good numbers. And to have that participation rate really increase, we've seen about 1 million new workers added to the labor force over the last about 4 or 5 months. That's a pretty big number. And so when you're getting an average of 240,000 jobs for 3 months, that doesn't even gobble up all those workers, and then that's where you can see that unemployment rate kind of tick up a little bit. So not too concerned with that. Wages up above 3% now, 3.2%. Usually the sweet spot for wages is between 3 and 4%, where it doesn't have a huge impact on profitability, and wages help consumers, which then go out and spend money and help the economy. Once we see wages go above 4%, typically, historically, we've seen that it's had an impact on profitability. So that's definitely something we've got our eye on. It also can start to give us some inflation, which right now there's not too much concern about inflation, and that's one of the reasons the Fed is a lot more dovish than they've been. But the U.S. economy as a whole still looks to be very, very strong. We had some demand pick up in 2018 because of the tax reform, and we pulled it from future years into 2018. So we saw 3% GDP growth from the third quarter of 2017 to the third quarter of 2018. We'll get GDP numbers for the fourth quarter next week, but that's pretty strong growth from where we were previously at about 2%. So we probably pulled some of that demand into 2018. We'll see if it's sustainable or not. And we'll continue to look at how those GDP numbers are looking and how metrics that go into the GDP look before those numbers come out as well. So U.S. economy looks really, really positive compared to a backdrop of global growth that doesn't look as good as the U.S. So definitely the U.S. has held up much better than international and emerging markets have. One thing that I wanted to point out here is really just how much noise can be in the stock markets, and why we really need to have long-term horizons when we put money into the stock market. You can see in 2018 that fundamentals, earnings growth, were fantastic in 2018. If I had 2017 up, you could see that 2017 was fantastic also. Yet we lost money in the stock market. Well, the reason we lost money in the stock market was multiples contracted. People weren't willing to pay for earnings streams like they were in 2017. They didn't want to pay 18, 19 multiples. They wanted to pay a lot less. So that was what the major cause of the stock market losses in 2018 were, because people were not wanting to pay as much for a stream of earnings, i.e., these were sentiment driven. News headlines come out and people are not as confident anymore. Instead of paying 18, 19 times earnings, they want to pay 14 or 15 times earnings. And so that's exactly what we saw, especially the last quarter of 2018. In January, we basically had a reversal of that, i.e., we have some good data points come out. People start to think, oh, we're not going to go into a recession. This is just a slowdown, not a garden variety slowdown, not a recession. And then boom, we have exactly the opposite. Now people are willing to pay 15, 16 time multiples instead of 14, 15 times multiples. You get a slight expectation of earnings going down barely, but you get stock prices up 6 to 8% in the first month of the year. So it's completely sentiment driven. And so when you have that, you really need to make sure that you have the right time frame, because you don't know if it's going to be one of these times when people are going to change sentiment and they're going to only want to pay 14 or 15 times, or if it's going to be a period of time when they're going to pay 19 or 20 times. Typically, at least for the S&P 500, people pay 16-ish times. And so the longer time frame we have, the more realistically we can find a point where people are paying 16 times and get decent returns from our equity positions. Earnings, at least for the S&P 500, have come down. So you can see this red line is 2019 earnings. That they start predicting earnings in 2017, and the closer we get to 2019, the better idea we have of those earnings. And you can see we had a height at the end of 2018, and we've really been bringing down those earnings ever since. So in October of 2018, the earnings for 2019 were about $178 a share. And now you can see as of January 31st, we're at about $170. So that's about a 5% reduction in earnings for 2019 by analysts. One thing analysts do is they usually end up going a little bit too far in the one direction or the other. I thought this chart was just really showed that very conveniently. So here's Q4 2018 earnings, and you can see in 2017 they're just guessing. We're a year and a half away from Q4 2018, and they update, and then boom, the Tax Act became law, and boom, they increased their earnings projections because now these companies were going to pay less in taxes. Well, increased earnings. Right around the third quarter of last year, they started decreasing earnings, and now we're in the fourth quarter. We started decreasing earnings a lot more for the fourth quarter of 2019. You're starting to get visibility. We're actually in the quarter that we're talking about, and then boom, the first of the year. Now corporations are starting to provide these earnings. So they're filing their reports, and you can see that they brought earnings down, and now the companies are reporting, and now the companies have been beating earnings expectations. So we're seeing that turnaround again of earnings expectations, and we'll get new estimates for Q1, Q2, Q3 of 2019 here coming up pretty soon as well. But I thought this little purple line here was a good way of showing, okay, earnings expectations. We went just to quarter two earnings expectations. So we went from quarter three to basically back to quarter two of 2018 earnings. So it wasn't that big of a drop. We dropped 6 months back to where we had earnings 6 months ago. So not the end of the world there. Not worth 20% S&P 500 percentage points like we saw in the fourth quarter of 2018. And that's part of why you're starting to see some of these stock prices come back up. The long-term driver of stock returns are fundamentals. Things like earnings, things like dividends. These are the things that drive stock prices. So where does that put us today? And really, this is what I'm talking about when I say that it's a little bit more difficult environment to be a portfolio manager right now than it was a month ago. So we've got earnings estimates for 2019 of about $170 a share. The current S&P 500 stock price is 2,700. It's a little over 2,700. That puts us at about a 16 multiple. 2,700 divided by 170. 16 multiple. Well, that's about what people pay for the S&P 500 earnings. So we're neither overvalued or we're neither undervalued from a historical perspective, we're right about fairly valued when it comes to the S&P 500, which represents large cap domestic companies. There's a caveat. The caveat is that the 10-year Treasury rate is now 2.65. It's not close to 3, where it was for a majority of last year. So there are a lot of models out there that say in a period of time when you have a 2.65% Treasury rate, people will pay 17 or 18 times multiples. Okay. Well, we still think that interest rates are headed north. So at this point, domestic, we're probably going to get somewhere between 5 and 6% annualized return over the next 5 to 10 years if we were to look out that far from our domestic large cap holdings. It's better than cash, better than most bonds, but it's definitely not the 10% of the 80s or 90s that we saw in the S&P 500. As long as earnings can continue to move higher, then the stock market can continue to move higher as well. So it's all about what we think earnings are going to do and how large cap U.S. companies are going to do when it comes to the S&P 500. For me, it's when it's fairly valued, you want a neutral stance to something like that. Versus, I'm going to skip this because we kind of talked about this. We already talked about this as well. We had a really good 2017 for earnings. So this is earnings per share growth. We had 17% in 2017. If we look at 2018 as a whole, we had about 25% earnings increase in 2018. So those are pretty good earnings numbers. You can see we most of that's come from margins. Margins have actually been hit a little bit by increasing costs, and the fact that they were up above 10% makes a big difference. And now we're not going to get that tax reform win that we had in 2018. So some of that's going to come out of there. We did have a lot of buybacks in 2018. Those are going to lead to better earnings per share numbers because there's going to be less stock outstanding. You can see we had a significant amount, almost twice as much as some of these other years in recent history. We had about 550 to 600 billion, and we almost had $1 trillion in stock buybacks in 2018, and a lot of those announced, and they've been announcing these and getting money to work at decent levels. So that's going to have a future positive impact on earnings per share. But I still believe that if we look at the U.S., we're looking at more of a fairly valued environment. And you can see that here. Here's global valuations, 25-year historical valuations. 16.1 is about what people will pay for S&P 500 earnings. This was as of the end of January. We're actually, we just did the math on the previous slide, and we were at right about 16. So we're right in line. It doesn't mean that we should sell stocks. It doesn't mean that we should buy stocks. It means we're gonna expect to get average type returns from the U.S. stock market. If we look outside the U.S., it's a different picture altogether. We're still significantly undervalued in developed markets, Europe, Japan. We're still significantly undervalued in emerging markets. And if we have some trade rhetoric that starts to be positive with Trump and China, we could see emerging markets do fairly well. So that's where we see some of the opportunity. Is not necessarily in the U.S., it's outside of the U.S., which has been the same for the past couple of years. Taking a deeper dive just on some of the economics, just to show you the things that were in the previous slide about the U.S. economy. Like we said, we've seen a tick up in the unemployment rate here to 4%. Not concerned because, once again, we had participation rate increase. Wage growth in January up 3.4% annualized. Consumers look fantastic still. Low debt, high assets, high net worth. Household debt service still not very high. So a lot of these we look at each quarter. So I'm kind of flying by these because they don't change all that much. One thing I did want to bring up with federal finances is a few days ago they kicked up talks about the Social Security 2100 bill. Social Security and Medicare are now more than 50%. You add those two up, it's 51%. They're 51% of the federal budget for 2019, and they're only going to continue to get higher. So I urge you to take a look at the Social Security 2100 bill. Basically, what I gather from this slide and from looking at the 2100 bill, I would plan on higher taxes, higher payroll taxes in the future, possibly higher taxes higher payroll taxes on income. So if you want more details, you can look at that Social Security 2100 bill. But these are things that if we believe taxes are going to get worse, there are things we can do with our financial plan that I encourage you to talk to your financial planner about here at Ironwood to reduce your tax burden at a later point in time. If we can take advantage of the current tax environment, which current tax environment, in our opinion, is very positive. We don't see how it could get much better. So taking advantage of these tax rates the most we can is a very positive thing for most people's financial plans going forward, especially if we think taxes are going to get worse, which I believe this slide is basically telling you that that's got to be the case. Okay, growth 3%. Like I said, 3% year over year, Q3 to Q3. Last quarter, 3.4%. This next quarter, Q4 of 2018, the numbers are going to come out next week. We think that it's going to be right around that 3% number. Once again, not really a sign that the U.S. is going into recession. International. Okay, so that was the U.S. So basically, a summary of the U.S. is we've got decent growth. We've got decent job market. We actually have a fantastic job market. However, prices are reflecting a pretty good environment, and we're not getting a very good deal on prices. We're getting a fair deal on prices for U.S. stocks. International, there's definitely some more going on. The China slowdown has had an impact. You can see right here. Eurozone GDP growth has been declining for a couple of quarters now. A big part of that is, okay, net exports. They've had positive net exports for many of these quarters. Last quarter, they had a negative impact from net exports. I would say mainly that's a big driver of that is going to be this China slowdown. Now, there still are some positive things with the Eurozone as well. We've got wages significantly improving. I mean, we're talking 10-year. We haven't seen these types of numbers in 10 years, both on wage growth and on unemployment. So those are positive. And we've got credit demand at decent levels. China definitely slowed down. A lot has to do with trade. They've actually decreased their reserve requirement. There's a lot going on with China right now, and there's a lot of domino effects from China. We are in the camp that we've kind of seen the worst of it as of yet. We believe that that growth will continue to move forward, that we'll start to see some better ISM numbers, some better PMI numbers going forward with China, which will improve Europe and some of the other areas as well. Emerging markets, the long-term story. I know we've talked about this in the past, but always a good thing to bring up. Between China and India, we have over 1 billion people where we're going to take them from poverty level into the middle class over the next 10 or 15 years. That's going to be a significant tailwind to the growth of those economies and to the stocks that cater to those economies. And then just also another relative price to book ratio of emerging markets versus the S&P. You can see we're undervalued. So as you can probably understand, we are more optimistic with our emerging market and international stocks than we are our domestic. It's not to say that domestic is overvalued and we need to jump ship and get rid of it. It's much better than it was a month ago. As far as prices are concerned, it's just from a future return perspective, it's just not as attractive as we'd like it to be compared to some of these other areas. And that's typical in history. We go through periods of time when international and emerging markets will outperform domestic and vice versa. We've just gone through a period of 11.1 years with 106% outperformance by domestic stocks. Given where we are currently with prices and with earnings and with valuations and looking at the next 10 years, we find it very hard to believe that this trend will continue. We see an opposite trend starting. And we want to make sure that our clients have exposure to that. Here's just another way of looking at it and looking at some of the valuation metrics. All Country World Index X the US, since the recession, it's up 104%. Whereas the S&P 500 is up 300%. Forward PE multiple for the S&P, 15.7 versus its 20-year average, 15.8. Dividend yield, 2.2 versus its 20-year average of 2%. Okay, so like I said, S&P 500, not overvalued, not undervalued, fairly valued. All Country World Index, PE ratio 12.5, 20-year average 14.1. Okay. Dividend yield 3.6%. We're getting 3.6% to hold these stocks. That's a pretty good payday to hold these international companies. Get a 3.6% dividend where we can reinvest, which is a significant undervalued compared to its 20-year average. So that's where we see value. It hasn't changed for several years. It's been the same kind of story, with the exception of January when domestic stocks also became cheap. But the last month has kind of reversed that. So now we're not jumping up on the sandbox, pounding, saying we should just buy everything that's aggressive. We want to be a little bit more picky now, given where prices have gone over the last month and a half. Central banks, we talked about the Fed, 2.63 at the end of January. We're at about 2.65 now. We've had a bull market in bonds for about 40 years now. The Fed has come out and they're really dovish based on the global slowdown that they see. So I think they may be on pause for the next year. If you haven't refinanced your house in the last couple of years, and you were kind of upset that you didn't get a chance, now might be a time that you want to look at that again. I think you'll be surprised at the types of rates that you see compared to even 6 months ago. Central banks across, not only just the Fed, but central banks across the globe have slowed down and have become more dovish. So I would probably look for less hikes in 2019 and possibly some cuts because of the slowdown. I would also be on the lookout for the Federal Reserve to change their dot plots. This is the last time we got data, but they've changed their stance significantly since the last time they gave us these dot plots. So I think they're probably closer to where the market has them priced. Although I think that they'll still be a little bit higher than what the market thinks. And the Fed basically is data dependent, and we believe that they're on hold for at least 2019. And what does that mean? Well, that means for our retirees who have, a significant chunk in bonds, it means that interest rates are probably not going to increase all that much from where they are now. And that when we're at low yield environments, we don't expect a whole lot out of our fixed income side of things. But it doesn't mean that we want to abandon that either. Earning 3.5%-ish, 3.5% is still better than what cash is paying us right now. And it's a pretty stable type return. And it gives us that cushion, that negative correlation to some of our stock holdings. High yield had a bit of a blowout at the end of 2018. You can see right here, and then it's come back down. But the reason I added this, one, rates are a little bit more attractive in high yield. So if we are okay with increasing our credit risk, we can get a little bit better return. And you can see, just trying to put it in perspective, the 2015 slowdown, global slowdown, you can see that high yield rates spiked even more. And in 2011, they also spiked more. So we've come down a bit, definitely not near the lows, but we're still at attractive rates at 6.72% on the high yield bond composite. So how do we want to navigate? Cash, still not a good long-term asset class. In 2018, it was one of the best asset classes. That doesn't happen very often. The times that happens is when we have pullbacks in global equity markets. But over a long period of time, cash is not going to be a great builder of wealth. In fact, it's usually going to be losing to inflation. Right now, with where short rates are, it's paying slightly higher than where inflation is. That's changing, on a month-to-month basis. But bottom line is, cash is going to be safe, and it should be a big staple of your short-term 1 to 3 year income needs and expense needs. But it should not be a large portion of the portfolio. We've got a lot of cash that's on the sidelines right now, and it's earning less than 2%. At some point in time, that money is going to have to be moved to other asset classes, and when it does, we'll see some of those other asset classes to do a little bit better than they have. It'll just be another tailwind when people start to move some of this cash that's on the sidelines. I don't want to be completely negative on the S&P 500 because it's still giving us a good earnings yield. compared to bonds. I just want everybody to know that we prefer international and emerging market stocks to domestic. It doesn't mean that domestics are a bad asset class right now. You can see that there's still significantly higher earnings yield, which is just the PE multiple inverse, and looking at the S&P as a bond type investment. We're getting 6.9% earnings yield for our dollars versus the Moody's BAA yield of 5.1. So you can see that typically that's a sign that domestic stocks are more attractive on a relative basis than domestic bonds. When there's big gaps here, that would have been a really good time to reduce some of our stock holdings and increase some of our bond holdings right before the big 2001 dot-com bubble. And then on the inverse, after 2008, we saw a big gap the other way, and it would have been a good time to have overweighted stocks relative to bonds during this last 8 to 10 years. Profit margins have come down a bit, so that's something we want to keep an eye on. It's another reason why we've seen a lot of choppiness in earnings estimates for 2019. It's because that tax bill and wages going up have had an impact on that. So we'll want to continue to watch that. But revenues going up by 10-ish% a year, like they have. Even if this profit margin gets cut a bit, we could still grow at single digits on our earnings growth if nothing else happens. So it's part of the equation, and we want to make sure that we keep an eye on that peak earnings. We've talked about this one in the past. I'm going to skip this one. Commodities, oil below $60 a barrel, going from $75 a barrel down to $50 a barrel in a very short period of time. This is going to be a headwind for companies that use fuel, airlines, consumers. It's going to be a negative, obviously, for some of the energy companies, but we definitely look at commodities as an asset class that is not correlated to bonds, not correlated to stocks, and that over a longer period of time will keep up with inflation and be an inflation hedge to the portfolio and give us some volatility so that we can, on our rebalances, buy it if it's not performed well, and if it's performed well, we can sell it and use that volatility along with its zero correlation to the rest of the portfolio as a good portfolio tool. I know bonds aren't very attractive if we're looking at 3% on the ag, but over the long run, they do smooth out returns. And if we look at this period of time from 98 all the way until the end of 2018, you can see that we started with 100,000 in both these portfolios. One's 100% S&P, one's 60% S&P, 40% aggregate, the bond aggregate, the Barclays bond aggregate. And you can see that the ending value, they're pretty much identical. They're $4,000 difference. But the 60-40 portfolio came with a lot less volatility. So somebody who's just buying and taking from their portfolio, we definitely need something that's going to be an anchor in the portfolio. Somebody who is younger and who's adding to their portfolio, they would have done, if we would have looked at adding money every single year to these portfolios, the S&P 500 one would have been better because you have more opportunities to buy low. You you were buying all during this period of time, and then you had this big increase, and then you're buying all during this period of time, and then you had this huge increase. And so the dividend reinvestments, the payroll deductions, and the retirement plans, that's why it's imperative to make sure that you have the correct portfolio for your objectives. And so when we're looking at long run returns, and we look at this, it's not always bad to have bonds. There definitely are positives and negatives. But if you're in retirement and you need income from your portfolio, unfortunately, one of the best areas to do that with a negative correlation to stocks is bonds. Having the right time frame. I know we've gone over this before, but it's so important. If you don't have 5 years, if you need money within 5 years, it really should not be in either the bond market or the stock market. A 50-50 portfolio, its worst period of time has been up 1% over a 5-year rolling period. So you've never lost money over this period, 1950 to 2018. You've never lost money with a 50-50 portfolio over a rolling 5-year period. So it just shows you the benefits of having a diversified portfolio. But definitely, if we have 1 year, we can't tell you with certainty, with much certainty, where your return is going to be. If you're in stocks, the best year has been 47%, the worst year has been negative 39%, and everywhere in between. Bonds up 43, down 8. A 50-50 portfolio down 15, up 33. It's kind of the roll of the dice. We are here to help our clients make money. If they're giving us a 1 year time horizon, we don't belong in the stock market. We don't belong in the bond market. We belong in cash. Cash is where the 1 year money should be. In fact, cash and safer security is probably where the 1 to 3 year period of time money should be. And not until we get a 5-year period should we start talking about stocks and bonds. 10-year period. Now there's never been a 10-year period where a 100% bond portfolio has lost money, with the exception of a 1% loss in a 10-year rolling period. Stocks are a pretty good bet over 10 years. But if we can roll that to 20 years, now stocks are really good. The worst return we've got in any 20-year rolling period has been 6% from stocks, 1% from bonds, and a 50-50 portfolio is 5%. And our up case is 14, and our up case is 17 with stocks. So really, the long term being 10 plus years, now we can start to expect decent returns from our stocks and our bonds. Shorter periods of time, it's all over the board, and it's nearly impossible, if not impossible, to know which type of environment is going to happen next. I added this slide just to kind of go back a little bit, go back to 2015, 2014, global slowdown fears. Sound familiar? 2015, global slowdown, China, Fed uncertainty. That sounds really familiar. A lot of these things that have caused stock prices and volatility, this is a measure of volatility here, but we can go back and look at the different volatility measures that we've had and see what's happened with the stock market, and know that this last rising rates, trade, rhetoric, peak growth, we could throw in global slowdown, we could throw in China there. I mean, these all they sound very similar to each other, and you can see the volatility, it spikes and then it comes back down. And if you were to have left the market at basically any one of these periods of time that's on here, where volatility got as high as it did back in December, you would have really missed out on a very big S&P 500, at least if that's what we're looking at here, S&P 500 return, stock market return portfolio. I mean, basically any asset class you look at, if the volatility would have caused you to change your long-term perspective, long-term strategy, it could have been detrimental to your long-term objectives. So I just wanted to put this in here to show that although every time is different, a lot of times things rhyme, and that's kind of what we saw at the end of 2018. Stocks are volatile. I think we've kind of talked about that one. Last year we had a 20% drawdown, almost 20%, round up to 20%. Ended the year with the S&P down 6%. Believe it or not, that's pretty normal. The average intra-year drop is 14%. We had 20, not significantly higher than the average. We need to use those periods of time. If you're still accumulating for retirement, you need to try and use those periods of time to get some assets to work. If you're in retirement, those are times when we want to try and let our equities do their work and use our fixed income portfolios to live off of. But that's par for the course. That volatility is normal. And one of the reasons we have bonds is a bad year in the bond market is a bad day in the stock market. And you can see bonds have an intra-year drop of only 3.1% on average. So it's a lot harder to do harm to yourself in a bond portfolio, and then add in the fact that over long periods of time, bonds are actually negatively inversely correlated to stock prices. The two together really are a portfolio manager's best tool. Last 15 years, an asset allocation portfolio, diversified portfolio, up 6.2% per year. Not that much off of large cap, S&P 500 returns. Going forward, if you look at long-term capital markets expectations from some of the larger firms, the next 10 years, we're looking at probably around, according to our models, and then looking at some others, somewhere between 5 and 6% from the S&P 500. Maybe about 8.5% from emerging markets, maybe about 6.5% from developed markets. But the point is that in this type of an inflation environment where rates are low, the next 10 years, we probably won't see 10% type returns. It'll be much lower. And so when we're planning, we want to make sure that we're planning with lower type returns, which if you're working with Ironwood, which most people on this call are, we've already lowered those expectations inside of the financial plans, and those are the type of numbers that we're using to give you Monte Carlo scenarios and your plans. So if you're working with Ironwood, we've already done that for you. But over the last 15 years, asset allocation portfolio about 6.2% with about 10.3% volatility. Overweights, same overweights that we've had. Small cap, we believe is going to do better than large cap. Developed international equities, emerging markets. We added on here emerging market debt. The credit spreads that we're seeing in emerging market debt look really attractive. Underweights, fixed income, domestic equities, REITs, utilities. Interest rates have come back down. So some of these areas that had taken it on the chin a little bit in 2017 and early 2018 have kind of reversed course because interest rates. We think the Fed is on hold, but that doesn't mean that the 10-year Treasury can't creep back up to 3.5% over the next year or two. So if anything, what's happened is this slowdown has given this economic expansion another leg up, which is where our base case scenario is. We believe that in July, this expansion will become the longest expansion in history. We believe that will happen. We don't see a recession in the near future. And because of that, we still have portfolios tilted towards aggressive assets within the parameters of each person's investment policy statement. But we're definitely on the more aggressive side than conservative side. So with that said, I will open it up to questions. And Nick, will you please cue the questions?
Sure, and I'm kind of trying to paraphrase this here. I'm going to read the question exactly, and then I'd like to give a little more context. This question is related to David Stockman recently. So he was the former White House budget director under the Reagan administration, and he's been on TV a lot lately, kind of speaking negatively about his outlook for the market, obviously sounding bearish. And I found something in November where he predicted a potential 40% downturn. Of course, that was back in November. Here we are now. I'd like for you to kind of comment on his thought that we've got a massive artificial structure of debt in the U.S. and how that could, what could happen, with the funny business with currency and interest rates and things that are happening right now, which I think some people described as like a zero boundary economy in a sense. In other words, not much room for error, I guess, with what they're doing. I don't know if that makes any sense what I kind of just said there, but if you want to make any comment.
I go back to this slide here, and this slide does concern me. Longer run, and this is one of the reasons that we're looking at 5 to 6% S&P 500 growth versus 9 to 11% S&P 500 growth over the next 10 years. First of all, anyone who says that they predict the market's going to go down 40% over any time frame, or up 40%, or they're just trying to predict where the markets are going to be over a short period of time, I'd be very cautious when listening to any of those predictions, because it's very, very difficult, if not impossible, to get short-term predictions right. That's why you always hear Jeremy Siegel, very, very prominent economist and portfolio guy. He always makes 10, 20, 30-year predictions. Warren Buffett always says, well, the stock market, the Dow will hit 100,000 or 50,000, or it's just a matter of when. So anyone who predicts where the market's going to be over a short period of time, I think, first of all, that's very, very hard, if not impossible to do. And usually I turn off my attention to those types of folks, because generally it's been proven that it's very, very difficult to do that, if not impossible. But on a longer term basis of the question, do we have a debt problem? We are beginning to have more and more of a debt problem, and the number one culprit of that is Social Security and Medicare, our entitlements. I was very pleased, literally, I think it was Monday, that I got an article about the Social Security 2100, and it's basically a bill that is going to make Social Security sustainable through 2100. That's why they're calling the bill 2100. It calls for basically an increase of Social Security taxes from about 15% to about 18% on income earners. It gets rid of the unlimited income that it gets rid of just, okay, after 132,000, you no longer pay Social Security. There's actually, they're talking about a gap, so like 130 to 140,000, wherever the number is for the year. Then there's a big gap where there's no Social Security tax from, let's say, 130,000 to 400,000, but then it picks up again at 400,000 to unlimited. So they're trying to go after the wealthy, I guess, the higher income earners on that. They're talking about increasing the taxable, the tax-free amount retirees get. So if you have a taxable income of 100,000 or less, that they would not tax Social Security at all. So they're talking about revamping the system. I don't agree or disagree with any of that. Just the fact that they're bringing it to the forefront. As you can see, 51% of the budget for this year is Social Security and Medicaid. So that's definitely something that should be on all Americans' minds, how that's going to play out. The government gets to control how taxes, what taxes look like. And so an easy fix to this is to increase taxes. Well, if we have increased taxes, well, then we have less money to go and spend on capital investment, spend on buybacks. So it's definitely going to have an impact on longer term returns. I don't think that it's an imminent issue, and I would never try and predict where markets are going to be in the short run.
Okay. We have no other questions. So again, if anyone does think of anything overnight or what have you, just email myself or Scene or your primary advisor, and we'll be glad to address those questions for you. You want to wrap it up there, Scene?
Sure. Thanks for everybody for joining the call this afternoon. It's a lot nicer talking with everybody when the markets are up, but it doesn't mean that the easy work is done. Not free money, but the easy money has been made in January, and now it becomes more difficult. So don't just tune out because the portfolios are doing a lot better. It's important that you have a good discussion and relationship with your financial planner at Ironwood, and continue those discussions and make sure that we are updated with your objectives and goals, and that we're making sure that the portfolio fits. So with that, we will talk with everybody in early May. Have a great rest of your week, and we'll talk soon.